First things first, I want to just take a little bit of a victory lap on Gopro. I've been very, very bearish on this stock since the IPO. I hated it the entire time. What got me so bearish on GoPro? I didn't like the CEO that he unlocked the shares early, whether it was for charity or for whatever. You don't do that. That's a big no-no in my book. And I also didn't like the fact that they made a product that I didn't think had much longevity in terms of growing their TAM, which is their total addressable market. There's only so many people, so many crazy mofos out there that are going to jump out of planes and off the sides of buildings and hang themselves with bungee cords and so on and so forth. Also, what was the replacement cycle? Like if you buy one GoPro, unless you your parachute doesn't open and you smash it, and in that case you're not going to be buying a new one anyway. I mean, what's the reason? Once you own one, why are you upgrading? It's like not like an iPhone. There's no subsidies. They're really overpriced. They're really overpriced cameras, and they didn't come out. One thing that really to me was like the death this season was that they didn't have a new product for the holiday. On a side note, they're going to lay off 7% of their workforce. That has to be really motivating for their staff, considering the CEO just bought himself a nice big yacht, and he's talking about their new drone program called Karma. Maybe this is a little bit of karma for Mr. Woodman that his stock is getting the C-smack. Anyway, the stock is trading in the 11s right now. I've for a while said it's going to probably be single digits. That still wouldn't surprise me. So anyhow, that's that on. I still don't like this stock, by the way. What I will take out of this, there are two things to take out of this this GoPro. One is they're probably going to hit the Fitbit on it too. But I think Fitbit may, if it's down into their earnings, could set up as a long. I think they probably had a bit of a better holiday season. I don't think they really had anything that new, but it just seems like they're kind of in the right space, at least for this year. I think next year they're going to be making Fabergé Easter eggs also. But with regard to the Fitbit, it's if that is down into their earnings, that would probably set up for a bit of a pop. Although this, like I said, that stock is also at all-time lows. It's another one of my silliness stocks that I don't like, and that to me would just be a pure speculative play for a bounce. Ambarella will likely get hit on this as well. The repercussions of a bad GoPro. Ambarella has some interesting support. I actually was looking to set up a right out long buy off 36.49, which was the breakout, and it also would coincide with the trend line. The problem is that we bounced a little bit. We bounced a little bit already off of there. It got 40.22. It didn't quite get the full extension lower, and if we kind of get back down there, I'm not so sure that trend is going to hold. I would have liked to have seen that kind of the first time. So I'm a little bit cautious with the Ambarella. If that retraces the entire move, by the way, you're talking about like 21. I don't know. That's a bit of a big call right here. Let's see how it handles the 36.49. But, that's probably going to suffer a little bit. Anyway, let's get into some of the other stocks. Some people had asked about the cybersecurity stocks. I'm kind of just going through the things that have just been destroyed, and then we'll kind of back into the market. We haven't really been in a bull market for a while in terms of stocks, and these are all bull market stocks. I think that they just got a little bit too bulled up ahead of time. FireEye, I've had my differences with their CEO also for doing similar things like Mr. Woodman with unlocking shares early. I don't like that. I hated that stock for a long time. I'm starting to warm up to it a little bit now. CyberArk got the takeout, the bid, and it seems to me like these stocks would fit really well inside of other companies when they get beat up enough. That being said, stocks that are making lower lows and lower highs, it's a bad pattern. When you want to buy a stock, you want it to be making higher lows and higher highs. And you also have a rather negative market at your back at the moment. I did a poll today. It was a little over 100 respondents, And I asked, are we in a bull or bear market? And about 77% so far said we're in a bear market. Last night for the State of the Union, I asked how is President Obama handling the economy, and over 50% of the people said poorly. So that shows you the sentiment. Things are shifting for sure. Let's talk about some of the reasons, the catalysts here. So I always talk about my six market keys, that being the VIX, the dollar, the bonds, the oil, China, and biotech. And some of those are in a pretty bad way right now. In terms of the VIX, we did close just shy, we closed just over it. 25.20 is sort of the line in the sand for, crash risk, and once you're over that, it's problems. That just shows that more people are reaching for protection here at elevated prices, and the market is vulnerable. As long as you're above that, that is vulnerable. Today we had the opportunity to try to break. We saw below 22 in my pre-market vlog, or whatever the hell you want to call this thing. I thought the RTH close in VIX was, no, all right, I thought it was just shy, but it was over 20, it was 22, all right. I had said that the 22 was the pass, don't pass line. If we got back above 22, the low today was 21.44. If we got back above 22, I thought we were going to see 25, and that did play out in quite dramatic fashion. The dollar is not really making too many more gains. I look at the UUP, but it is still in a consolidation mode. It's kind of higher for longer. That is not good for corporate earnings. It is very troubling for businesses that do work overseas. The key kind of the resistance of the range, that it had broken out of the range, broke back into the range, tried to break out with a lower high. And now today we closed, I think we closed right on the 50. We closed actually right on the top of the resistance. So it's sort of like right on the tail line of support if the breakout is to hold. I think the Fed really needs to be really worried about this. I really don't understand what the hell they were doing with their stupid rate hike. A lot of people argued with me about this, and they didn't think that a Fed rate hike would matter. They said, it's only a quarter of a point. It doesn't make a difference. It's not going to affect anything. And to that I said, no, that is completely, you're not looking at it correctly. And the reason that we're having the problems we're having now is that the Fed changed their policy from accommodation to tightening in the midst of a global growth and domestic growth slowdown. That is not the cycle. What the Fed wants to raise rates when you're in an upswing. They don't want to start when you're already over the mountain. And in this case, they're like handing the coyote, if we want to talk about Roadrunner terms, they're handing him weights to carry on the drop down. So I really don't understand what the hell they were doing. I think that they need to, I don't know if they're going to really eat crow. You still have Vice Fed Chair Stan Fisher coming out today saying that they're still basically on course. Yeah, the Anvil. They still are on course for raising rates 4 times next year. The market isn't pricing that in right now. I mean, if anything, the TLT is showing that rates are going lower. So I think the market is starting to sniff out the recession. They keep putting out these. I'm going to go off on a slight tangent here, but I think that it'll kind of ring home to some people. They keep putting out these bogus numbers saying the employment's good, the economy is sound. This is kind of the equivalent to the Paulson, the fundamentals are sound. And I think people are just not buying it anymore. I mean, look, the market realizes that things are not good. You've had crappy jobs that they keep trying to say are good. These are low-paying jobs, part-time jobs. These are jobs that are the ones that the numbers they were citing were like holiday jobs of like gift wrap, and things like that. That we've become a nation of waiters and waitresses. The job quality is terrible. GDP is stall speed at best. I mean, it's like barely holding on by its fingernails to positive territory and very, very much in risk of slipping into recession. We've had, junky ISM numbers. Both the servicing and the manufacturing have been contractionary. The PMI has been contractionary. These are the same around the world, too, by the way. Durable goods orders, everyone keeps talking about how great the auto sales are, but, that's really dependent on, first of all, low interest rates and a good economy. I think that they've had the wind at their back in terms of low interest rates as well as plummeting gas prices. But we may be hitting peak autos here. I mean, that's what the stocks are telling me. They're reporting these great numbers, and the stocks can't get out of their own way. I think they're getting beaten up a lot by the crowdsource sharing economy, like Uber, Lyft. All of these services, I think, are making it less attractive to own a car and to do Lyft or Uber. I've already talked about the dollar, and the last Fed key really is the S&P 500. The Fed, I think, didn't quite understand the gravity of that quote-unquote flash crash. That was sort of the warning shot, and now they're getting, the follow-on effect. And I'll tell you, just politically, since we're in political season, I think this is why you have guys like Trump and Bernie Sanders doing so well, because people are just fed up with the bullshit. They're tired of being lied to. They know things aren't doing well, and that's why they're supporting these candidates. These outsider candidates like the Trumps and the Bernie Sanders, because they know that their system is broken and these guys are burning down a corrupt system. So anyway, we'll end on that with that part. Anyway, with regard to the markets, some of the stuff we talked about here, I'm just debating if I want to let's do the indices first. Someone just wrote, the Fed ashamed to admit error. I think they might be ashamed to admit error. This really hurts their credibility. The European Central Bank, when Trichet was still there, by the way, who I think was one of the potentially the worst central bankers in the history of central banking, came out and they raised rates into a recession, and we all know the woes that Europe has gone through, and we'll probably have to go through this again soon with Greece with their debt restructuring. I believe that's going to be happening like any week now. We can start looking forward to eating souvlaki again in a couple of weeks. All of these countries have been living a lie with entitlements and retirement ages that are ridiculous. I will say this, though. One thing that I have to be consistent with this. I did say that I thought high energy was killing growth in Europe and in Asia, and I have to tell you, low energy is going to eventually, that's the key word, eventually help their growth numbers. So I wouldn't be surprised to see if Europe kind of can lead a bit of a bounce. So we're going to have to see how that plays out here. They don't have the natural resources that the U.S. has, and I think that they have been plagued by high energy prices, and it's triggered a lot of these recessions, and I think that lowered prices are going to start helping them at some point. That, however, has had a cascading effect negatively here. The TV guys are all like saying they don't understand why the market's going lower with lower oil and lower gas. That, I guess 6% of what consumers spend on is energy. And I know my energy bills have been a little bit lower in terms of what I'm pumping into my gas tank. And the problem with cheap oil, and I've mentioned this is what I've said from the beginning, is that it's being used as a proxy for global growth. The marginal buyers are not in the U.S., it's in the emerging markets. Obviously, that is down significantly, so that's what's killing it. But more impactfully, yes, sure enough, the lower prices will eventually help businesses and help consumers. But, here's the big but, 15 to 17% of the market is made up of energy companies, and as those shares go lower, that's a tremendous weight around the S&P. Also, a lot of the growth in the jobs that have been coming in those sectors, in oil and gas, in states like that have these shale plays, and I think that those layoffs are going to be very real. They're going to start. They've already started. I think BP made some big layoffs. They were laying off a bunch of workers. I will tell you this: whether you like this or not, I don't care how you sit politically or ideologically or. Companies are going to lay off and cut back exploration and before they cut their dividends. So that's going to just be a fact of life, and I think a lot of rigs are going to be already shutting down. We're in the midst of a lot of the stuff that's being talked about is that the Saudis are looking to put a lot of these producers out of business, and they're also trying to punish Iran because of their geopolitical issues. So I really think that we're going to see some massive rounds of layoffs, and this can start really impacting the major the economy here. I mean, the jobs picture. I mean, those are really good. Yeah, North Dakota, Oklahoma, Texas. Yeah, that's right. I mean, all of those shale plays that had those economies that had huge booms, they are all majorly underwater. These producers need oil to be well over $50, some of them $70. A lot of these companies have leverage. This is what's been weighing on some of the high yield and junk bond markets here, pulling down those securities. I wouldn't say it's the same. I guess you could say it's sort of like the same as the Big Short. Those were mortgages. This is bonds. I guess they're wrapped up into those indices, and it's pulling down. The weak always brings down the strong, and that is a big problem. You're seeing some really big companies trading at some astonishingly low levels. I don't think people would think possible even a couple of months ago. So that is going to continue to drag, and the Fed keeps worrying about. They see, things going well, and they're worried about theoretical potential inflation when they're dealing with very real, right here, right now, deflation. And as long as that persists, I believe that you're going to have some big problems. The markets. So let's talk about some key levels here some no-nonsense levels that we're looking at. Let's just start with SPY. That's always that is the S&P. I always deal with the ETFs, so let's just deal with those levels. So SPY basically is right on or maybe right below a very minor trend that caught it on the kind of the flash crash day. There are some reference support levels at 186.93 and then all the way down at 182.40. There was also an old reference low down at 181.92, but that is significantly lower. If you want to talk about the trend from the bull market from the beginning from 2009, it's pretty low from here. If it were to open up there tomorrow, you'd be looking in the 173s. That's also oddly a reference low and would be a symmetrical low, 173.71. And I'll tell you, I've been discussing this for a while, even before this correction started. And I said that this was going to be tough to play because I didn't know what the time frame would be. But the 2000 and 2007 tops, the latter being 157.52, has never been retested. And I think a little bit below there is a 50% fib of the entire move, but it really wouldn't shock me, to be honest, if that was retested. And I'll tell you my sort of fundamental and technical thesis behind that. Technically, it would be once you break out, you usually tend to retest the old resistance, and that should theoretically be support. Fundamentally, a lot of those gains were all because of QE and the Fed, and now that they are taking that away, the party is over, so to speak. It's sort of like the lights came on, and now people have to figure out what they're going to do. That's not a foregone conclusion, although I would say that so far the symmetry is really looking absolutely perfect. Like if you folded at the peak the S&P in half, the tops here, this sort of big rounded top, is looking very very symmetrical. And that kind of works on the way down. And if the 181.92 area doesn't hold, you're looking at the 173s, in my opinion, and probably a primary trend touch. That will be a great long for a right or right out trade for quite a large rally. We'll have to see the way we get there. That's always very important. Like if we stop just ahead of it and keep bounce a little bit, that's not so good. It's better if you come down there in sort of a cascading fashion. Short term, though, I will say this. I'm just looking at the stochastics. They are beginning to get oversold. the average bar isn't below the lower band, but the solid bar is. So I think we're getting kind of into the oversold territory where we'll probably see some type of a relief rally and bounce. I will say this, that everyone is sort of looking for this relief rally and bounce to kind of sell into, and when that happens, you usually don't get it so quickly. You need some more puke. The last 2 days have been really some of the ugliest technicals maybe I've ever seen in a market. The ticks yesterday and today were like, today you even had a low negative tick of almost minus 1,600. It was minus 1,599, and almost all of the bars, with the exception of a few, were cascading, hitting 1,000 and below. That's really pretty bearish. That's liquidation, that's whatever. That's distribution, it's just selling, panic selling. I don't know how long that's going to be sustainable for, but, keep in mind, we're pretty well off the highs here, but relatively speaking, still rather high. As far as the upside goes, what would the bulls need to do to neutralize the situation to kind of make this go away? Here's the way they would do it. They need to get the market back up into range above. There's the 197.86 to, let's call it 199.84. Let's just say 200. The bulls really need to get the market back up over 200. If they can get it, the SPY back up over 200, I would say that they have neutralized a lot of damage, and this would have just been another one of these sort of, almost corrections here. We are definitely in correction mode. So that's what they would need to do. With regard to the bears, they just need to, like I said, keep it below those same numbers. And if they do, the market remains suspect. It's been, it was sort of in a bit of a channel down. Now it's just getting sloppy. You need to see some real capitulation selling, in my opinion, for the market to kind of have a tradable low in. And the problem we keep having is that you get these swoons. We've had these late day rallies, and then they rally the futures up overnight, get all the overnight inventory long, and they gap up the market, and then it gets sold off all day. It's sort of like dangling bait in front of a hungry animal. You don't want to do that. So what I think for the market to really bottom is you need to have some type of a lower open, a gap lower open, get on high volume, and then you need to have some type of a reversal day. I thought we had a great opportunity to do that on Monday and Tuesday. It did not happen. Maybe it happens next Monday and Tuesday. Although I think Monday, I believe, is closed. So I think we have a holiday shortened week. So I'm sure that tons of people are going to want to be long into a long weekend, right? Anyway, we're at Wednesday here. I do think that we should. The problem here is you've had a couple of days sort of like attempted bounce, 2 days, and then today basically was an outside day. You went over the high and then closed below all the lows. Really quite ugly, actually. A lot of that was thin. It was just in a more of a waterfall. If you just looked at the market today, it started out as selling, and then it got very steep. It wouldn't surprise me to see some type of a relief rally either. We closed about 28 handles. Right now we're about 28 handles below the VWAP, which was up at 1911.48, so 1911 half-ish. So yeah, it wouldn't surprise me to see some type of a bounce, but the market, like I said, it's really not acting very well. Bull markets have gap downs that get bought. Bear markets have gap ups that get sold. So I'm inclined to think we are in some bit of hot water here until those levels, like I said, can be that can neutralize the market are achieved of 200 plus. IWM is getting it even worse. That is the small caps, the more speculative names, if you will. They peaked out a while ago. Believe it or not, the high in the IWM was 129.10 in June, looks like. and we are now struggling to hold 100. So that's a pretty big smackdown. The good news, I guess you could say the good news, is we are close to a 1.618 fib extension from the last swing low to swing high, which would come in at 98.91. The bad news is we are through a very big trend line today. We are actually through the lower part of what I drew in as a channel here, although I guess if you drew it a little bit differently, we're kind of right on it. Yeah, I guess we're within tolerance, so we're sort of on the lower end of the channel. So I would think that there would be some type of a response of moves, considering we came down from over 115 just a couple of weeks ago. So a week ago, actually. That's how many trading days is this? We've had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days, like in a week and a half. That's a pretty healthy decline. If IWM was to get back to the 2007 peak, that would be 85. So not sounding so crazy, is it? Qs have been the strength. We all know what's been holding that up. That's FAANG right there. That's all your NASDAQ 100. The bad news is if this really starts rolling over, you could be in for some really severe pain. 104, 105 was a really key level. We were well below there. That was the 61.8 of the kind of the pullback low to high. If you do a full 61.8 from the flash crash low to high, that comes in around 96.59. However, in my view, anything below like the 99s starts really looking toppy. That was the sort of the consolidation triangle. You don't want to spend much time below there. If we snap that, I think we'll see trend at 90. That's really where the primary trend is in NASDAQ. Keep in mind we are coming from an all-time high, so I don't necessarily know that this is going to completely just collapse here right away. I will say this, though, that some of the big stocks that got us here, let's just go through them here. Apple, I had talked about that being a bit of a long play in the 95s and then saying that that was going to get some resistance between 100 and 103. Perfect. I took that off yesterday. I talked about closing some short puts. Today it looked all right early, and then it just kind of fell apart. Apple has some reference lows around 95. The channel low, if it got there on like tomorrow, would be roughly around the flash crash low of 92. The big 61.8 is around 85.72, and their big gap fill from this entire run is 74.96. I know that sounds nuts, but it really could happen if the market gets really kind of ugly. I like put ratios playing for a bit lower. Like I said, the best case scenario would be for this to happen ahead of the number, to have some type of a washout, get all the fear built up, get the options juiced up, and then guess what? You could sell some majorly out of the money puts. I was looking at some of the OI for the month-day report, and I was seeing a lot of OI in the 95s, the 90s, and the 85s. I don't know where we're going to be. I haven't put this trade on yet, but what I was thinking about doing was something, I don't want to get too cute with it, but I was thinking about buying 95 puts, selling 90 puts, and then also selling 85 puts. So I have like an overwrite at different strikes. So that might be how I play it. I'll probably do something like that, but the strikes might have a different derivation depending on where we are when we get there. So, or where we are when they report. They'll probably do something stupid like rally Apple ahead of the number, but the best thing that they could do, honestly, is just sell the bejesus out of this thing and set it up for a long. Get the capitulation ahead of time. What I affectionately refer to as shake and bake. That's Apple. Moving along in FAANG, Facebook is looking a little bit toppy, like it just needs a little bit more pullback. Some important levels here that I see are anywhere between 91.33 and 93.56, and then it's in the 86s, 86.06 to 86.76. That area to me is key, and then of course 83 would be kind of the tail line of support for the stock. I said it would get 100. I said I thought it would get the excuse me, the 109, and it did. It actually exceeded it. It got 110.65. It did the same thing with the consolidation. Keep in mind, this is coming off of all-time highs, so I don't expect this thing to completely collapse. Longer term, I am very bullish on Facebook. Short term, I am still a little concerned. It is kind of like consolidating here. You have a 200 MA, which was some big support in the past. That's in the 92s now. So I would say if you're long, you could be long against that level. And if you want to try RORO, that would be your level to try it against. If you want to do it the Chicken Little way, sell some out of the money puts, and don't panic if it kind of gets there. Big picture, like I said, I'm real bullish on Facebook. Short term, I've been saying this for the last couple of weeks, that I am cautious, and I will remain so. Amazon. So I have a trade on in Amazon. I see how it does. I don't know if it's sort of a, I don't know if I would say a moonshot, but it's going to take some more movement lower to really pay off. I'm long a 1/2 put ratio that expires Friday. I'm long the 560 puts and short 2 times the 545s. Those strikes were not pulled out of thin air. The 61.8 from the kind of correction low, the last real major significant low was 544.76 is the 61.8. It's also sort of like was a major area in a consolidation range, so it also only has 2 days to go, and we're also well coming down very strongly off the highs. The major trend line in Amazon, like if we were to gap there tomorrow, which I am not expecting, I would also not be very happy with the play I have on if it did this, would be close to 500, and that's close to the 50% fib, which is 490.85. So I'm expecting some type of I don't think that we're going to see that type of a move so quickly. Amazon also, by the way, has a gap fill at 563.91, so that's why I picked those strikes. The basically the gap fill and the 61.8 with only 2 days to go. So that's my story with Amazon. I had drawn in a little bit of I wouldn't say it wasn't an official's Andrews pitchfork, although I don't really even use that tool. But it was, I guess, just a bunch of different trend lines, and we are below the hammer that held it, which was 2 days ago, well below there. And, the stock is looking like it's correcting. I had said, again, if I had, actually, we are starting to enter oversold territory. It's below the lower bound of the what am I saying here? Not the RSI, the stochastic lower band, and the average hasn't caught up yet. That's when I think things really at bottom, but I wouldn't say that the stock is overbought anymore. It is in the big picture, but it is starting to get short-term oversold. So I'd be looking to start to play this for some type of a bounce soon. Netflix. One I had been a little cautious on. This one was sort of starting to roll over earlier than the rest. I had said that it was looking like a bit of a double top pattern. If you want to check my weekend review video, I kind of go over that a little bit more. I've been saying 115 is a key for the stock to hold. Anything below there is bearish. Anything above there is bullish. 110 was the next key level. And then I had said that if we lost that, of course, we're looking at 103.88 to 105, which worked. There is another few levels that are below here, like 99s and 93s. So if 103.88 busts, that's probably what you'll see. The stock looked like it really wanted to correct more. It kind of had a gap down. Then it was sort of it was accepting price there. It kind of looked above and failed, and then we had that news that they went international. So that gave you really a great opportunity to sell it if you missed it. And I think a lot of people just kind of took that opportunity and they got out. and that's kind of what's happening with Netflix. For a while, I have said I didn't know the timing on this, but at some point, I think that $70 is revisited. I don't know. I'll probably I don't know how long I'm going to be waiting for that. I don't know that happens now, but that was really where the big breakout and everything happened. So it really wouldn't surprise me if that eventually happened. There are a lot of levels that the stock would need to breach well before then. I don't necessarily know that is going to happen, but I would say the best thing, again, with this stock to do is to sell off again even further and finally get some capitulation, and that there's still a lot of people holding these stocks, retail people, and they need to be, I guess, get the shake and bake. If they rally this thing ahead of the print, we'll have to see. This stock has defied gravity for quite some time. It has defied quite a lot of, I guess, the rumors of the death of Netflix have always been greatly exaggerated. I'm bullish on the company longer term. I think they are taking tremendous market share. I think they're really destroying the cable model of the bundle, but the stock is up a lot. It has been an amazing stock, and I just think it needs a little bit more time to pull back and correct. Like I said, I'd love to see this thing pull back more ahead of the print and set up for some type of a long. But if they rally it ahead of time, it could be actually pretty ugly. Google also, I said, just was getting a little bit ahead of itself. It got up above the channel high. I'm sorry, it was getting close to the channel high. It didn't get above the channel high. I'm sorry. It is now taken out 2 days worth of trade with, well, it closed just on that with a bit of a engulfing pattern. It stalled. It couldn't hold up above the 752.05 gap high from a couple of earnings ago. Anything below there to me is a little bit vulnerable. It is still within that range. I would love to see Google fill that gap, the earnings gap, get to some type of a trend line. Again, the same story, my same story. I'd like to see a little shake and bake in these names, get a little bit of capitulation in there. These stocks are all still coming off of all-time highs. They usually will have a sell-off, at least another leg up, and then before there's really any major stranger danger of a move down. So that's the story with FAANG. I think they were just victims also of their own success early last year. I mean, all of last year. I think they're just people who are kind of, they're high dollar amount stocks, and they're very liquid and easy to sell. And I think that people have a lot of margin calls in commodities and various other instruments, and they're selling what they can, locking in gains now that they don't have to pay taxes on those stocks kind of now while they can, and the prices are still high. So what else do we want to cover here? Bank America, someone asked about. That's actually one I've been watching. 14, the lower 14, mid to low 14s have been the lower end of the range. I hate the banks, but I would say it's a row play. I may actually take it myself. It just looks like a large consolidation. 18s have been kind of the end of it, and then 14s. So I'll try it as a range trade. I don't particularly love the fundamentals of the company. I don't particularly like their earnings prospects, but it's just a pure technical play. Sure, why not? Exxon was the only green stock in the Dow today. It is above the downtrend. It is roughly holding the, it kind of held the tail line of support the other day. It's interesting because even as oil was going down, Exxon was kind of holding its stuff together. So these are some key levels around here between like the 72.5 and the, what was this low? Hold on. Yep. 72.56 was the low. I kind of knew that without even checking, but 72.5 to 75. Really, Exxon needs to get up above and clear 76s. It kind of had a bit of a look above today, but we really kind of sold off late in the day. I think that really hurt it. Let's see how that plays out. I think the big story, and this is just pure speculation, I don't know anything, is that I think Warren Buffett is going to take his stake back in Exxon at some point. Really wouldn't surprise me when they do their their filings of stocks that if Warren Buffett was started to initiate back into Exxon. If he hasn't here, I'm sure he will at some point soon. It's a name. He, of course, sold near the highs, and maybe might be interested in getting back in here. But I do believe that their dividend will kind of be safe for a while. If oil gets cut in half again, this is not going to go over well for any stock. Same story for Chevron. They have big dividends. They have now a 3-day low in place. Today's high kind of stalled right at the old uptrend line. That uptrend has been broken before. This is sort of a retest. This is sort of where the last swing low was. So it doesn't surprise me that there were a little bit of sellers. I don't know that Chevron is as good as Exxon, but it's better than a lot of them. So these companies have pretty impenetrable balance sheets. We're going to just really, honestly, the truth of the matter is that you're going to have to pick some points in these stocks, probably if you're feeling for the bottom, and just test them. If you want to play long against that 3-day low, that's the way to do it. If you want to play short against the 3-day low on a violation, that's another way to play it. So that's the oils, the big oils. Someone asked about Yahoo. Really not that much to see there. I mean, what is the business at Yahoo? It was a holding company for Alibaba. Marissa Mayer is not really proven very effective in doing very much other than enriching herself with huge bonuses and payouts. So I use the internet, I search. If I'm looking for a product, I go on Google or Amazon. I haven't used Yahoo in years. I don't know anyone really who has, other than if they're checking sports scores. They have a pretty good app for that. If you haven't tried the Yahoo Sports Score app, try that. And then, of course, Yahoo Finance. But I really just don't see them having a model and a growth business. It's just sort of a game of attrition and kind of hoping someone buys them. At some point, maybe. We'll see. I think they screwed up big time when they didn't sell to Microsoft, and they probably should have done that. Disney, they are like kind of, they had their big fall out of bed moment. They got to 90, and now then they kind of almost filled the gap, and now they're kind of just coming back down. I think the theory here is the cable cutting, that people are going to cut the ESPN bundle and not pay for the sports as much. I think it's also a little bit more than that. That it's an expensive vacation, and I think a lot of people, if the economy isn't doing well, might not be visiting their theme parks as much. We'll have to see how that plays out. Honestly, the stock looks like a big double top, and if they lose that 90 swing low, the high might be in for like years. The big breakout was amazingly down at 67.89. I don't know. That's a really big move lower. There was a big gap fill in like the 71s. There was this big rally that kind of like started the blow off, started from 78. Your first here breaking trend. So if you if you did a 61.8 from that like kind of low that kind of got the big thing started, you're close at 95. There'll probably be some reference buyers there. It's really oversold in terms of the stochastics here. The gap already had filled, but around that 94, 95 level, I think that you'll probably see some interested buyers again. But the stock to me looks like it's probably got some trouble. It'll probably have some type of a rally to another lower high, and then it'll start rolling over again. We'll have to see how that plays out. Anyhow, I think that we've been on for a while. I've been definitely talking long enough here. If you missed this broadcast or came in late or want to see it again, check it out on my YouTube channel. That's Justin Pulitzer Trades. You can probably should subscribe to that so you'll get notifications when I post new videos. I do weekend reviews and also Periscope rebroadcasts as well as special edition videos. If you're not following me on Twitter, my handle is @JustinPulitzer. I post a lot of trade ideas, and check them out. Anyhow, let's hang tough here. The market's getting obviously very choppy. One tool I want to give people before I leave to use is use a maybe beta weight your portfolio. This is a very useful trick I use. I've been doing it with the Qs mostly because I trade in mostly momentum stocks, and I find when I'm making more money than let's say on up days, then the market is returning for consecutive days, I start thinking it's time to liquidate portfolios. Same thing on the downside. If I'm, if I'm losing more than the market, I get a little bit concerned as well. So that's a good gauge just to kind of see how you're doing against the market. Anyhow, that's my story. I'm sticking to it, and cheers.